Let's come to assurance services. We just discussed audit related services. Now let's come to assurance services. Introduction and available what gathers as far as assurance services are concerned. Why the need for assurance services? Why the need for assurance services? Traditionally, the assurance rule of the professional provision of audit services within a statutory framework. The audit of published annual financial statements. That's where most assurance services are done. But we also have some other assurances anyway. An audit provides a high level of assurance, but not absolute. Mind you, high level but not what? Absolute. The requirement for an audit of the annual financial statement therefore has the objective of adding assurance. Credibility. When you say assurance, you are adding a credibility to the financial statement under audit. Now, however, the management of companies and other organizations are required or expected to report to shareholders on a wide range of information, both financial and non-financial, that is not subject to statutory audit. But mostly when you are talking about audit and assurance, and especially audit, it means it's about what? Financial. This might include such matters as corporate governance issues. Yes, you can give assurance to the management or to shareholders about what? Corporate governance, including risk assessments and internal controls. So they can call on you to give assurance on how management is managing the risk, how they assess risk and so forth, how the internal controls are working and so forth. E-commerce and the operation of e-commerce activities. Systems reliability, how to rely on the system. You can give assurance. Then performance measurements. Then value for money, that is VFM. Available guidance on assurance engagement. Any assurance you are going to perform, whether it's a limited assurance or what, reasonable assurance, you need to follow. The international framework for assurance engagement, an international standard on assurance engagement. Now, the international framework for assurance engagements was revised in 2013 and described the objectives and elements of an assurance engagement. The framework makes a distinction between what? Attestation engagements and direct engagements. Then the framework also makes a distinction between what? Assurance assignments that give a reasonable level of assurance and assurance assignments that give a limited level of assurance. In assurance engagements, it is not possible to give what? An absolute level of assurance as a result of what? The lack of precision, often associated with what? The subject matter. The subject matter may not be precise. Then the nature of the evidence available, the nature, and then the time scale involved. Because of these three elements, you don't have absolute assurance. You don't have absolute level of assurance. Okay? But you have reasonable, okay? So reasonable level of assurance, where a reasonable level of assurance is given, the risk attached to the what? Assignment is at a sufficiently what? Low level to enable the practitioner to give positive assurance. That means you need to do more work so that the risk will be low. Reasonable assurance can only be given in the following circumstances. So reasonable assurance engagement can only be given in the following circumstances. The subject matter of the assurance service engagement is the responsibility of another party. Yes, somebody is responsible for the what? The engagement. And the subject matter is identifiable and can be subjected to evidence gathering techniques. If these two techniques are not there, it is impossible to give a reasonable assurance. Limited assurance, on the other hand, where only a limited level of assurance is given, the risk is higher than that for an engagement where the accountant is able to give what? A reasonable assurance. Under these circumstances, what they are saying is that you do less work, so the risk is higher. But in the case of reasonable assurance, you do more job, so the risk becomes lesser. The risk is sufficiently low to allow for a negative expression of what? The accountant conclusion. Negative conclusion, okay? Accountant's conclusion. Negative expression of what? Accountant's conclusion. Example is a negative opinion, that's it, as in a review report. Now, assurance engagements, non-assurance engagement. There are some engagements which are not assurance. In addition, the framework distinguishes between assurance and non-assurance engagement. Example of non-assurance engagement are preparation of tax returns. Auditors can be asked by their clients to prepare tax returns for them. The management or tax consulting and agreed upon procedures or compilation engagement. All these things are what we call non-assurance engagements. International standard on assurance engagements 3000. Key general points from this standard set out below. Ethical requirements. They are saying that one thing you are doing, that's the International Ethics Standard Board for Accountants, ethical code, should be followed in this work. Then quality control, appropriate procedure for quality control of the accountant's work should be applied to each engagement. The engagement should be what? Planned and performed with a degree of what? Professional skepticism. This is the third time we are meeting this word, so it's very important. Before completion of an assurance engagement, the client may ask for the nature of the engagement to be changed to a non-assurance engagement. That's is an area that they can ask a question for the level of assurance to be reduced. If this happens, the practitioner should consider whether the request is appropriate and should not agree to the change unless there is a good reason. If there is no reason, please don't. Now, the objective and nature of assurance engagements. What are the objectives? The main objective of an assurance engagement is to obtain either reasonable assurance or limited assurance as appropriate about whether the subject matter information is free from what? Material misstatement. So, as far as assurance engagements are concerned, we have reasonable assurance and limited assurance. To express a conclusion regarding the outcome of the measurement or evaluation of the underlying subject matter through a written report that conveys either a reasonable assurance or a limited assurance conclusion and describes the basis for the conclusion and to communicate further as required by the standard and any other relevant standards. Elements of an assurance relationship and assurance engagement. For every assurance engagement, there should be what? A practitioner. There should always be what? A practitioner. That's what we call three-party relationship. Anything, that's whenever you are doing an assurance engagement, there should be what? The first thing is that assignment should have a three-party relationship. One of the three-party, not third party, is three-party relationship. Within the three-party, there should be what? The practitioner, the one who is the accountant. And then there should be a responsible fellow person who prepared the financial statements or who gave the information. And then there should be intended users. So this is a three-party relationship. Three-party relationship. One, the practitioner, who is the accountant, then the subject matter. If it's a balance, if it's an income statement, that's it. If it is a review of financial statement, that's it. Then there should be what? First, the accountant, the subject matter, there should be intended users, those who are using the information. They should be there. So three-party relationship. Then there should be what? A defined subject. That means there should be subject matter. If it's a financial statement, let us know. Suitable criteria for assessments. You can't conclude without matching what the fellow has done against a particular assessment or criteria. Suitable criteria should be there, and then there should be sufficient appropriate evidence. And at long run, there should be a report. So every assurance engagement have 5 elements. 3-party relationship. And within the 3-party, we have the practitioner, we have what? Responsible fellow or person, and then we have the subject, the users of the subject matter, those who are going to use the information. So that is the three-party relationship. Then we have a defined subject matter, the subject matter. Then there should be a criteria. Then there should be sufficient appropriate evidence, and then lastly there should be a report. Every assurance engagement should have these 5 elements. Now, suitable criteria for assessments. Suitable criteria are the standards against which the subject matter of the assignment is assessed. Let's take, for example, if you are talking for suitable criteria in this case, it means we, the accountant, say the financial statement is true and fair. Why are you saying it is true and fair? Because what they have done, management has done, the way they prepare the financial statement, they prepare it in accordance with the accounting standards, and then the relevant laws in that particular industry. Once they have done it in conformity with those, it means that they have done it in accordance with the relevant standards. So you use the standard as a benchmark. Then the process is more difficult in more subjective assurance engagement in areas such as customer care, labor relations, etc., etc. The report prepared by accountants at the end of an assurance engagement will include the following elements. Any reports that comes out by an accountant, there should be a title, addressee, identification of the level of assurance obtained, then subject matter of the report, suitable criteria you are using, any inherent limitations. Where appropriate, a statement that the use of the report must be restricted to certain qualified or specified users, or that the use of the report should be restricted to a specific purpose for which it was prepared. A statement to identify the responsibility, and then a statement that the engagement was carried out in accordance with this and that and that. Then a summary of work performed, the practitioner's conclusion, the date, name, and address. So the report structure is very relevant. Now, situations are limitation of scope. What is the conclusion you draw? If you are not allowed to access all documents, the first right of an auditor is rights to access all documents. Now, if they fail to give you the document, they are limiting your scope. So you qualify the opinion, or you disclaim it. Assertion made by the responsible party is not fairly stated. Once it's not fairly stated, either you qualify it or adverse. Then the subject matter has been materially misstated. Materially misstated. Either you qualify it or adverse conclusion. and then the criteria are unsuitable or the subject matter is not appropriate to an assurance engagement. Either you qualify or you write adverse conclusion, or otherwise you qualify the conclusion or you disclaim it. When we come to report writing, these things will be clear to us. Main types of assurance engagement. Engagement relating to risk assessments. They can ask you to what? Assess and see whether the management is assessing risk and managing risk very well. When risks have been identified and analyzed in this way, management has to come up with what? Strategies to manage risk. So it means that once they are able to identify risk, then they have to manage it. There are various strategies. We have, if risks are low impact, low that's probability, then they may well be what? May well be accepted. Yes, once the risk is what? Very low, and is the probability is also very low, then you can accept it like that. You can leave it like that. That's acceptance. Where the risk is very high, you can either transfer it by insuring it or managing the risk, or putting internal controls in place to manage it. High risk. If risk is high impact, high probability, it might have to be avoided. Once the risk is very high and is impacting seriously on the company or whatever, and the probability of it happening is very high, avoid it. Avoid it. Don't undertake that transaction. Don't undertake that transaction. Then we also have the risks associated with what? E-commerce, particularly are looked at below. Assurance or risk assessment. That's monitoring risk assessment processes is often a task carried out by internal audit, but which could equally be carried out by external parties, such as audit firm and assurance engagements. So, what they say, assurance or risk assessment. That job is normally done by internal auditors, but you as an external auditor can also be called upon to come and assess and see whether risk assessment is properly done, and if it's done, are they managing it properly? So that's engagement related to performance assessments, the nature of performance assessments. So you can be engaged to what? Assess performance of a company or whatever it is. All entities should have measurement system for what? Measuring and monitoring the performance of different aspects of the entity's operations and activities. Performance measurement reports indicate to management whether the objectives of the entity are being achieved. Performance is measured and compared with what? A benchmark. That is a benchmark, such as target or what? Budget, or by comparing actual result with what? Results for the previous years or results achieved by competitors. There have been significant development in performance related to reporting in recent years. Many entities publish some or all of their performance measures. A wide range of performance measures may be used, including performance related to non-financial information. Then, in some countries, the government sets performance targets for government departments and publicly owned entities. Assurance engagement and performance. A client may ask a practitioner to provide assurance about the way in which performance measurements are calculated and presented. The practitioners will need to consider whether the performance measurement system operates as prescribed and intended. To perform such an engagement, the practitioner will need to understand the performance measurement system in use, assess and evaluate it, and test the effectiveness of its operation. Value for money. Value for money. Value for money means using the resources in the best way in order to what? Achieve intended objectives. And when you say value for money audit, it is the 3 E's. Value for money audit. It means you are auditing for, you want to find out if the resources are used economically. Economy, that is the first E. Second E is what? Efficiency. Whether they are doing the work efficiently. That's efficiency means using resources in such a way that they what? Produce the greatest possible amount of output. That's input-output relationship. It means getting more from the use of available resources. Then effectiveness, that is, effectiveness means using resources in such a way as to achieve the desired objective. So these are the 3 E's that we use, or when we are doing what we call value for money audits. Economy, efficiency, effectiveness. And that is the 3 E's. So anytime you are doing a value for money audit, you must remember the 3 E's. Now, objective of value for money engagement. Why should somebody or a company engage you to do a value for money audit for them? The purpose of value for money engagement is to investigate a particular aspect of our entity's operations and reach a conclusion about what? Whether the entity is what? Obtaining value for money. That's all. And so they are saying, economy, do it cheaply. That's the meaning. The economy means you are doing the thing cheaply. There are so many ways you can do it. Are you doing it cheaply? Then efficiency means doing it well. Are you doing it well? And then effectiveness, doing the right thing. And then we have what? The measurements here, which we call compare money spent with input acquired. That's efficiency, that's economy. Compare input used with output achieved. That is what? Efficiency and effectiveness. Compare output achieved with objectives. The practitioner's approach to value for money engagement. What is the approach? What approach will you take? The approach to performing a value for money engagement is summarized below. So if somebody engages you for value for money audit, the following steps need to be taken. For the particular aspect of operations, that is the subject of what? Investigation or audit. The practitioner should identify and develop methods of measuring the 3 E's. So that's the first thing. The 3 E's need to be measured or managed well. It is often necessary to assess the 3 E's by making comparisons and then having gathered and analyzed what? Measurement of the 3 E's. Then, if appropriate, the practitioner should identify areas of weakness and what? Make appropriate recommendation to the client about improvement that should be made. Now, engagement related to system reliability. System reliability, how to rely on a system. Let's say computer system, etc., network system. If an entity is not specifically involved in what? E-commerce activities, it is likely that a large part of what? Its internal information processing will be computer based. Yes, it's true. Therefore, major system failure will therefore make it difficult for many entities to operate effectively, especially if they use online system, yes, network, for their transaction processing. Management and other stakeholders may therefore engage a practitioner to give assurance on the effectiveness, that's effective and secure operation of their computer system. The general approach that the accountant should take for the assurance engagement is similar to the what? Approach to be taken for e-commerce activities, which we shall look at below. However, the accountant's work will focus more on identifying, evaluating, and testing controls within the company's information system. Computer assisted audit techniques, CATs, is also another way you can be asked to such as what? Audit software and test data are likely to be used by the accountant to carry out the work. Yes, CATs, computer assisted audit techniques. We use those software. They are all softwares that we use to interrogate the system. They are software used by the auditor to interrogate the system. Engagement related to e-commerce, yes, matters. E-commerce is a very important area because uh, entities may use information technology to conduct business transactions using what? E-commerce or electronic data interchange. EDI is the process of transferring documents between what? The computer system of different entities. An extension of EDI known as SETS, Secure Electronic Transmission, is used to process money transfers electronically for credit cards and debit cards. E-commerce is a general term that refers to trading electronically at distances between the buyer and the seller. Yes, it's true. So, an important aspect of e-commerce is that users of an e-commerce system need to have trust in the integrity of the system. So, if there's no trust, people, if you are using what do you call it, electronic data system, but the system is weak, people will never trust your system and they will never transact business with you. Both the buyer and the seller need to be confident that the details of their transaction will not be what? Intercepted by third party. Because they want the details of the transaction to be kept confidential. Because of this, we can ask an accountant or somebody, a practitioner, to assess the system for them and see and confirm whether the system is working as described. Risk management with e-commerce. Risk arise from the use of e-commerce systems such as what? Loss of transaction. If you are using e-commerce in doing your business, loss of transaction is real. And so people fear loss of transaction integrity. Yes, because transaction integrity, sometimes they'll say system failure. So your money is something, you haven't received your document and all those things. So loss of transaction integrity is something you need to consider. Then increase security risk with what? Remote trading than with what? Face to face. Yes. As far as remote transactions in e-commerce is concerned, it is very dangerous. The use of inappropriate accounting policy is another one. They say, for example, in respect of the capitalization of website development costs. You see, that's it. The legal and regulatory risk. This is the risk, for example, that e-commerce activities may be breaking the law in some countries. So management responsibility for e-commerce risks. Management responsible for some risks as far as risk e-commerce is concerned. So management should carry out what? Risk assessment exercise on what? Regular basis. It is their duty. Make sure you carry out what? Assessments, risk assessments regularly. The management should also create what? An appropriate control environment. Then including an information system security policy. There should be a policy, security policy there. Then the entity should make appropriate use of what? An internal audit function. Yes. Once internal auditors are there, they can be able to at least monitor the system and tell you, the management, where the systems are not working properly. Then there should also be adequate audit trails for e-commerce transactions. Audit trails are the footprints after every transaction. They are the footprints that can be audited, can be traced if the need arises. There should be adequate audit trail. I said it already. The entity should keep up to data backup copies of data files. Yes, it's true. Backups are necessary if you are doing e-commerce transaction, because as the system goes off, if you're not careful and you don't have backup, I don't know where you are going to retrieve those information from. Only Allah can give you that. For some systems, it may be appropriate to use encryption for data. Thus, encryption involves the electronic what? Conversion of data into what? A secure coded what? Language for transmission. Then the system user should comply with what? Generally what? Recognized standards and register with what? The Web Trust or a similar organization. Now, to audit, we have seen the problems that the management is supposed to do as far as e-commerce is concerned. Now we are going to audit the e-commerce. Don't sleep. Performing an assurance engagement on electronic processing system provides additional challenges for auditors. Yes. These include what? The need for specialist knowledge about e-commerce system. And then the problems that may arise when some aspects of the e-commerce system are outsourced by a client to another entity. The role of the client's internal auditors in monitoring the integrity of the e-commerce system. Then the need for specialist controls for the system. Possible problems of independence and conflict of interest. If the audit firm was what? Involved in designing or setting up the e-commerce system, that is now subject to audit. The audit approach to an e-commerce system should include the following. First of all, the audit firm should decide whether the engagement should be accepted. That's the first thing. Are you qualified to do that job? If you are not, don't take it. If the firm should then plan the engagement, an important aspect of planning may be to make available audit staff with appropriate expertise in e-commerce system. So in planning, consider expertise in that area. The firm should obtain a detailed knowledge of the client's what? It should consider liaison with what? The internal auditors of what? The client. If there have been internal audit investigations into the client's e-commerce transactions or system, the firm should identify and evaluate the risks in the system. It should ascertain and evaluate the control environment and the specific internal controls that are in operation. It may also be appropriate to perform a going concern review, particularly in the case of entities that rely mainly on e-commerce activities for their what? Income. Continuous auditing. Continuous auditing is a process which allows auditors to give assurance on a subject matter concurrently or shortly after the occurrence of the event on which assurance is being given, and therefore give assurance more frequently by using automated procedures. Continuous auditing requires using automated procedures which are embedded in a client system. So they require technical skills as well as what? Auditing skills. They will require strict controls and secure communication links to operate effectively. Prospective financial information. Prospective financial information. What is prospective financial information? Example is budgets. Prospective, meaning that anything that can easily be turned into what? A financial information. Prospective. Budgets is one. The nature of prospective financial information. As business and economic environment have changed, demand has grown for professional accountants to provide assurance on information related to what? The future. It's a future thing. Prospective. Such information is known as prospective financial information. PFI is widely used both within an entity and externally too. Yes, the budgets that we prepare inside the company, that's internal one. You can also be asked to prepare a budget and then probably send, if you want, especially want to float your shares. Internally, forecasts and projections are widely used as a form of what? management information. Examples include forecasts and projections, including that's relating to what? Revenue expenditure, that's capital expenditure, revenue expenditure, revenue itself, capital expenditure, profits, cash flows, working capital, etc. External uses include what? Profit forecast for providing to the stock market, forecast of cash flows to support an application for a loan from a bank, profit forecast to support or defend takeover bids, etc., etc. The auditing profession has traditionally been cautious about expressing a firm opinion on what? Financial information relating to what? The future. Yes, it's a risky job. Something that is future, how do you go and then say it into a fair? Definitions. Prospective financial information, they are giving the definition. Forecast or those things are not. So you need to read them. The assumptions that are used by management to prepare forecasts are called best estimate assumptions. You know, prospective financial informations are normally prepared by management, and therefore they use what we call best estimate assumptions. Projection. A projection is prospective financial information prepared on the basis of what? Hypothetical assumptions about future events and management actions that are not necessarily expected to take place, or a mix of best estimates and hypothetical assumptions. A forecast is therefore a best estimate of what is expected to happen, and a projection is an estimate of what is likely to happen if certain conditions or events were to happen. So projection is an estimate of what is likely to. So know the difference between forecast and projection. All right. So let's go to the examination of prospective financial information. How to examine it. So the standard says the examination of prospective financial information is the main source of regulation in this area. It provides guidance on what? The examination of prospective financial information and reporting on prospective financial information. It focuses mainly on numerical what? Information and numerical what? Forecasts or predictions. Now, accepting prospective financial information assurance engagement. Before you accept that job, prospective, which is future, before many of the points relevant to deciding whether to accept any audit or assurance engagement will apply to accepting a prospective financial information assurance engagement. Issues to consider will include the following: the availability of resources and staff with the necessary expertise. It's very important. Number two, the timetable for what? The completion of the engagement should also be taken into consideration. Agreeing a fee for the work with the clients is also another issue you have. So these are the three things you have to consider if you are thinking of what? Accepting prospective financial information assurance engagements. An engagement letter should also be agreed and signed by both parties before the work is actually what? Started. Now, procedures in prospective financial information assurance engagement. Procedures are, there are several specific points that might apply to what? Prospective financial information engagement. First, number one, that's understanding the nature of the information to be examined. Understanding the information to be what? Examined. Establishing the intended use of that information. Establishing whether the information will be for general distribution or limited distribution, and then the nature of the assumptions that have been made by management in coming out of those prospective financial information, and the time period covered by this information. These things need to be considered. When deciding the nature, timing, and extent of the procedures required to complete prospective financial information assurance agreement, the auditor should consider the following issues. One, the likelihood of material misstatement in the forecast or projections. Then two, the knowledge that the auditor has obtained during any previous similar engagements. 3, the competence of the client's management with regard to the preparation of what? Prospective financial information. 4, the extent to which the prospective financial information is affected by management's judgments. Then the adequacy, 6, the adequacy and reliability of the underlying data and assumption that have been used as what? The basis for preparing the prospective financial information. Procedures will include what? What procedure will you take? Where the audit firm has no previous knowledge of the entity, it should obtain sufficient knowledge of the entity and its environment. Know it now. Now the second one is what? If best estimate assumptions have been used in preparing the prospective financial information, the auditor should seek evidence to support these best estimates. 3, if hypothetical assumptions have been used, the auditor should assess whether they are realistic and sensible. Realistic and what? Sensible. Therefore, the auditor should assess whether prospective financial information contains all the relevant material items that nothing of significance has been what? Omitted. If part, that's 6, if part of future period in the forecast or projection has already passed, the auditor should review the actual result for that part of what? The period. And compare actual results with the cost and the forecast or projection. Then 7, the auditor should also check the arithmetic accuracy and consistency of the projected financial information that has been what? Prepared. 8, the auditor should obtain representation from management. Representation from management on management acceptance of responsibility for the information. Yes, the management should own the information, so they should give you management representation. The intended use of the information, the completeness of the assumption that they were made to prepare the what? Prospective financial information. So after you have done the job on prospective financial information, you need to report on it. As usual, the reporting structure is the title, addressee, identification of prospective financial information, a reference to so and so and so and so. So that is also the same reporting. It continues a statement of negative assurance as to whether the assumption that management have made provide a reasonable what? Basis for the so in this one prospective financial information is a negative. An opinion as to whether the prospective financial information is properly prepared on the basis of these assumptions. And then the report should also contain what? Warnings, that's caveats, that the prospective financial information is a forecast or projection, and the results indicated by the prospective financial information might not be achieved. Then you date it. All these are the contents of what? Now, pro forma financial information included in what? Prospectus. So sometimes when you want to register your company or you want to float shares on the stock exchange, you need a pro forma financial information included in a prospectus before they can accept it. So let's see, reporting on compilation of pro forma financial information. Now, increasing globalization of capital market has made it important for the financial information used in capital market transactions to be what? Understandable across borders, and for assurance to be provided to what? Enhance users' confidence in how such information is produced. Given this trend, the International Audit and Assurance Standard Board issued what? ISAA, then assurance engagement to report on the compilation of proper, that's pro forma financial information included in prospectus in December 2011. The assurance engagement to report on the compilation of what? Pro forma financial information included in the prospectus. The nature of international standard on how do you call it? International standard on assurance engagements includes the following. The practitioner provides reasonable assurance on the responsible parties. That's the client's compilation of what? Pro forma financial information included in a prospectus. The practitioner has no responsibility to compile the pro forma financial information for the entity. Such responsibility rests with the what? Responsible party. That is the client, the management. The reporting accountants. The company is preparing for listing on the stock exchange needs several advisors. Accountants providing assurance on pro forma financial information, included in what? Prospectus are just one. Other advisors include so much. Underwriters, stockbrokers, solicitors, issuing house, etc., etc., etc. So we have long form of reports, and we have short form reports, etc., etc. Now we are coming to another very important area: forensic auditing. Forensic auditing. Forensic accounting, forensic investigation, and forensic auditing. Forensic accounting, forensic investigation, and what? Forensic auditing. In general terms, forensic means used in connection with what? Court of law. In accounting, the term forensic therefore refers to the use of accounting information for legal purposes and the resolution of legal disputes or in disputes that are resolved by a court of law. So that is forensic for you. It may be used in both criminal cases and civil cases. Now let's look at them one after the other. Forensic accounting. Forensic accounting involves preparing financial information for use as evidence by a court of law. Examples include the provision of financial information relating to what? Loss of earnings, settlement of legal disputes involving the valuation of a business, losses relating to an insurance claim, a divorce settlement. There are two aspects of forensic accounting: forensic investigation and forensic audits. What is forensic investigation? A forensic investigation is a forensic audit carried out in response to a suspicion of wrongdoing, usually to prove or disprove certain assumptions. For example, X person is carrying out a fraud, or Y person was negligent in carrying out that piece of work. The objective of a forensic investigation is to obtain evidence that might be used in legal proceedings to resolve a dispute or prove innocence or guilt in a criminal case, such as providing evidence of money laundering. Forensic audit, on the other hand, is an element in forensic investigation. It's an element in it. So investigation is wider, and the audit is under the investigation. It refers to the methods and procedures used to obtain audit evidence in a forensic investigation. Good. Forensic auditing may be defined as the process of what? Gathering, analyzing, and reporting on data, much of it financial in nature, and the predetermined context of legal disputes or investigation into suspected what? Irregularities, and in some cases, giving preventative advice in this area. The terms forensic accounting, forensic investigation, and forensic audit are closely connected, and an examination question may refer to any of these three terms. The nature of forensic investigations and audit. The nature. How does it look like? Forensic investigations and audits are associated with what? Situations where disputes arise or wrongdoing has occurred, such that criminal or civil action is being taken in a court of law. The following general areas may give rise to what? Forensic auditing. Fraud investigation, negligence investigation, and then insurance claims and the assessment of losses. All right. How do you apply the code of ethics in investigation? So, application of ethical principles to forensic investigation. The ethical principles set out earlier apply to accountants carry out forensic work as they do to what? Accountants in every situation. Meaning that once you are doing investigation or you are doing forensic accounting, the ethics is essential. You need to comply with. The first one is integrity. Don't forget. Number two, objectivity. Objectivity. You must be objective. The third one is professional competence. Professional what? Competence. And due care. The fourth one is confidentiality. Confidentiality. And then the last one, professional behavior. Forensic accountants often appear as witnesses in what? Courts. And in the public eye, they should display professional behavior and act in a way that is not detrimental to what? The image of the accounting profession. Procedures in forensic investigation. Yes, if you want to investigate, the procedures you take. The procedures that a forensic accountant will carry out will depend on the terms and the objectives of the engagement. Terms and what? Objectives. In many cases, procedure will be similar to our auditing. In many cases, they said in many cases, the procedure for forensic investigation will be similar to what? Auditing. And it will depend on exactly what is being what? Proved or disproved. In others, the accountant may be preparing financial information from a number of sources to substantiate a claim. Substantiate a claim. Reporting on forensic audits. As usual, when you finish the forensic assignment or the forensic audit, you need to report. Key issues in reporting will be whom the report is intended for. That is addressee still. The title, addressee, and the rest, they still continue here. The type of assurance required. What purpose the report is required for. Thank you very much.